you did, they might have been referring to it in terms. Okay, let's get started. Okay, so today we're going to start talking about bottom-up betas. I kind of started the process in the last class where I essentially said regression betas are a recipe for disaster. So somebody remind me, what's the problem with regression betas? I mean, let's marshal the arguments, because you're going to be arguing against people who say, this is the way I was taught to do betas, is to run a regression or pull it off Bloomberg or borrow whatever service. What are the problems with regression betas? One is it's very noisy, that even if nothing has changed about your company, it is noisy, which effectively means what? There's a big standard error, that you don't have a number, you have a range, and the range is big. First problem. What's the second problem? It's backward looking by definition. You want a beta for the next 5 years, not the last 5. And with the regression, you always get a backward looking beta. And people say, so what? Your business might have changed, your company might have changed, your leverage might have changed, so backward looking beta doesn't help you. And third, if the only way you can estimate a beta is with a regression, and I give you an IPO to value, or GE capital to value, do you see the problem you're going to face? There are no prices. Without prices, you're up a creek without a paddle, you're stuck. So regression betas to me are not the way to go. And I suggested that the alternative is what I was going to talk about, averaging betas across companies, a bottom-up beta. Today I'll come back and talk about why I like that approach more than a regression beta. But let's set some, as I said, like every other class, we'll start some questions about what we're going to do today. So today we're going to talk about averaging betas across companies to come up with a beta for your company. So here's my first question. And each of you as a company you've already picked. I'm going to assume that that's already there. You're going to get to this stage and you're going to look for other companies that you can use to come up with a beta for your company. So would you like a small sample of companies that look very much like yours? In other words, you have a small chemical company in the US, you look for other small chemical companies in the US. Or would you like a large sample of companies where you've got to be willing to give up that some of these companies are going to be different from yours? Right? Or would you like one company just like yours? Maybe you can find another company out there that looks exactly like yours. An identical company, a small sample of companies that look a lot like yours, or a large sample of companies which don't look that much like yours in terms of size or where they are in the life cycle. It's really a statistical question, right? That's basically what it is. So what would you rather have? One company, 5 companies just like yours, or 50 companies that are very different? How many would go for one company just like yours? Okay. In which case, what have you done? You replace one regression beta with another regression beta. Right? So you'll have exactly the same issues. So one company will not do it. Now it's 5 or 50. I've kind of given away the answer. What are we looking for here? We want to eliminate the noise. Remember the law of large numbers in statistics? What does the law of large numbers require? Large numbers. Right? It sounds trivial, but that's what it is. Given a choice between 5 companies that look like yours or 50 companies that are dissimilar, they're in the same business but they're in different stages, I'd go for the 50 over the 5, 500 over 50. I'll start narrow. So if I can find 50 small chemical companies, I'm home. But if I find only 5, I'm going to have to expand my sample because I need the law of large numbers to work in my favor. So you're going to see this play out today when I make my choices for my companies, but keep that in mind. Now let's build on this proposition. We talk about comparable firms with betas. And all too often, if you worked at a bank or you worked at a portfolio management, comparable firms almost always is defined as companies within the same sector. So let me give you some choices on what you're going to look for in a comparable firm, and you tell me whether you'd like this and that. A firm in the same industry group, a firm in the same market. So if you're a NASDAQ company, maybe NASDAQ. If you're a US company, maybe the US. A firm with a similar market cap. So if you're a small firm, you want a small firm. Maybe it's none of the above, maybe it's all of the above. So basically I'm allowing you to pick your market cap, pick your sector. Maybe you want all 3. Or maybe you're okay with none of the 3. If you want all 3, what's going to happen? You're adding more criteria. Think of you're basically adding search. The way you search for companies is you go into Capital IQ, you go into Bloomberg, and you say, I want companies with market cap between 100 and 250 million. I want companies only in the US. And I want companies that are only in basic chemicals. Each time you add a criteria to your search, what happens to your sample size? It's going to get smaller. Maybe with all 3 criteria, you can still end up with 100. That's okay. But I want to redefine the word comparable today, at least for the context of betas. To me, a comparable firm is one that does well when you do well and does badly when you do badly. So if I'm a real estate firm in New York City, what should my comparable? So let's have a publicly traded real estate company in New York. Primarily, so its business is in New York, it gets most of its revenues in New York, and I want to find comparable firms. I can go find you other real estate companies that are, I probably can't find them all, but I could go across the US. But I think you'd be looking in the wrong place. What drives the revenues of the real estate business in New York? How well financial services are doing, right? If banks and investment banks are doing badly, I don't care how well you try to sell real estate, you're going to be doomed. Do you see where I'm going? Maybe the right beta to use for a real estate company in New York is not the beta of other real estate companies, but the beta for financial service companies. If you're a real estate company in Orlando, maybe the right beta to use is the beta for theme park or entertainment companies rather than... It kind of redefines what we mean by the word comparable. And it actually frees you because it means that you're no longer stuck in this sector definition that we've been trained to look at. If you're a software company, you have to look at other software companies. Says who? Why? Beta measures exposure to macroeconomic risk, and from that definition, I want to see other companies that do well when I do well and do badly when I do badly. You think, how am I going to eyeball the data? You don't have to, right? What did I just say? You want to see other companies that do well when you do well, do badly when you do badly. So statistically, is there a way you can find these companies? You're looking for companies that are correlated with you. So if I gave you 20 years of revenues for every company, you should be able to find 50 companies where the revenue changes are correlated by more than 0.8. It's a different definition of comparable. It kind of breaks the mold, but who made the mold? Why should we be stuck in that mold? Now let's talk about the cost of debt. Today we're going to talk about the cost of debt. It's far simpler than the cost of equity, but it's vastly misunderstood. So let's take an example. You've been asked to estimate the cost of debt for use in the cost of capital for a firm. The company has $1 billion in bank loans. So I've already told you, because it's bank loans, what have I told you about this debt? There's going to be no market value of it. It's not traded. And the interest rate on the loan is 4%. These loans have a remaining maturity of 8 years. Okay? So loans were taken a couple of years ago. You've got 8 years left on the loan. The current risk-free rate is 5%. And based on your default risk, you expect that the spread you would be charging, you'd be charged if you borrowed money today, is an extra 2%. So I've kind of thrown a lot of numbers at you. There's existing loans on the books at a 4% rate. The risk-free rate is 5%. You're a risky company. You have to pay an extra 2% if you borrow money. So I want a pre-tax cost of debt for this firm. And as I list each number, if it is not the number you will use, I want you to tell me why. And if it is the number you will use, that's fine. Just don't bring it up for the moment. Then at the end, when we get an answer, you can say, why not that number? So let's start with the 4%. That's the rate at which you have bank loans on the books. Would you use that as your cost of debt? So let's suppose, let me play devil's advocate. But that's the loan I have on my book. That's the interest rate. Why shouldn't I use it as a cost of debt?
Because you can't get any new loans on that.
Is there a way you can actually show that right now? Based on the numbers I've given you, show me why the 4% should not even be on the table. The risk-free rate is 5%. How can you have a pre-tax cost of borrowing, which is a current cost, that is less than the risk-free rate? The fact that you have loans on the books at an old rate is really nice. I feel happy for you. I will reward you in a different way, but I'm not going to give you a cost of debt of 4%, and here's why. If I bring in that 4% into my, let's say I'm a 95% debt company. I'm a company that can borrow an incredible amount of money. If I use a cost of debt of 4%, what's going to happen to my cost of capital? It's going to be a really low number, maybe lower than the risk-free rate, right? If I have a lot of debt. Then what am I going to do? I'm going to go out and take projects that make 4.4, 4.5% because it beats my cost of debt. And you can see why that's absurd, right? Because the risk-free rate is 5%. Why am I taking projects which make 4.3 or 4.4%? So the 4% is all, and that actually means that half of all cost of capital computations you're going to see are going to be wrong off the top. Because most use book interest rates. You know what a book interest rate is? They take the interest expense and divide by book value of debt, which is going to give you the 4%. So 4% is off the table because it's an old cost of debt. What about the 5%? Can I use that as my cost of debt? Why not? You're not unless you have a printing press in the basement, you have default risk. You cannot be using the risk-free rate as your cost of debt. It's not your cost of debt. You can see where I've led you, right? The cost of debt is the rate at which you can borrow money long term today. I know that kind of came out monotonous, so let me repeat that again. The cost of debt is the rate at which you can borrow money long term today. Two key words. You see why I threw the long term in there? Because if I let you tell me what you actually borrow money at today, and I let you pick the tenor of your investment, 3-month loans, 6-month loans, what are you going to be tempted to do to lower your cost of capital? Given that the term structure is upward sloping, you say, I'm going to take all 6-month loans. Look, my interest rate is really low. So I'm going to say, I don't care if you borrow at a 6-month or a 1-year time horizon. I'm going to act like you borrow 10-year because I've got to cover the long-term cost. So it's long-term, and it's today. So the 5% plus the default spread gives me my pre-tax cost of debt today of 7%. You're saying, what the heck is the 5.5? That is a particularly mangled number. That's neither fish nor fowl. It's if I take the 4, which I already have, take the 7, add the two numbers up and divide by 2. You see, why would I do that? People do all kinds of weird things. So right next to it, say, don't do this weird thing next to it so that you don't get tempted to ever start averaging book interest rates and market interest rates because they're meaningless. So the 7% is my pre-tax cost of debt because of the rate at which I can borrow money long-term today. In fact, the risk-free rate from which you build up your cost of debt should be exactly the same risk-free rate from which you build up the cost of equity. The 10-year T-bond rate is what we used. If you decide to go 30-year bonds for the cost of equity, then your cost of debt also. Now do you see why I chose the 10 over the 30? Because getting default spreads over a 30-year bond are so much more difficult. So that played a role in why I picked the 10-year T-bond rate as my risk-free rate in the cost of equity. So we'll talk about this more, and if you have any doubts about why long-term, why current, we'll come back to it today. Right? Finally, take this firm that I just described, right? It's got $1 billion in bank loans. Let's say it has $1 billion in equity, market value. And I ask you to compute the debt ratio for this company today. This sounds like a slam dunk. You're saying this must be a trick here. There is actually a trick here. Let's see if we can detect what it is. I want a debt ratio for the company. It has $1 billion in bank loans on its books and $1 billion in market cap. And I'll give you 3 choices, and they cover the spectrum. So there is no 4th choice. If you come up with one, tell me what it is. You've been incredibly creative. I'd like to know what it is. So it can be less than 50%, equal to 50%, more than 50%. Cover the spectrum, right? How many of you think it's going to be 50%? Looks like it should be, right? Come on, you be honest. It's billion, billion, billion plus billion is 2 billion. 1 divided by 2 is 50. But if you use the billion in equity is market value, right? Is the billion in debt market value? It's book value, but then you can do the investment banker's jig. You've seen this, right? I don't have market value, therefore I'm going to use book value as my proxy for market value. Do you have to? Can you give me at least a sense, if you go back to the previous page, of whether the market value of this bank loan is going to be greater than $1 billion, equal to $1 billion, or less than $1 billion? There's actually a very simple trick you can use to answer that. It's going to be less than, and why? Because the interest rate on the bank loan is 4%. The market interest rate is 7%. Remember bond pricing? If your coupon rate is less than the market interest rate, you're going to trade at a discount. You say, how do I know what the discount is? We'll actually today calculate the market value of the bond, because all you have to do is do what? Take the remaining 8 years of coupon payments at face value, discount them all back at the 7% rate, and you're going to come up with a market value of 920 or 930 million, which means your debt ratio is going to be lower. And remember I said I will reward you for having below market rate debt on your books? The way I reward you is I say, look, you have less debt than it looks like you have on your books. If you want to go out and borrow more money, I'm not going to penalize you. That's where you reward companies, is through the market value of debt being lower than the book value of debt if they have a lot of low interest rate debt on their books. Any questions? Okay. So let's review all these. So today we're going to cover all of these. So let's go back to the notes and start on the page I left you with. There are at least 3 or 4 of you over the weekend emailed me about getting betas for your companies. Actually, not the weekend, since the last class. Was it the weekend? Whatever it was. I'm completely messed up now. It was Monday. This is what happens to me twice a week, finally. But so a few of you are actually printing betas for your companies. I'm trying to use this as kind of a nagging device, saying if you haven't printed a beta off your company, you might as well try to do it. And they notice that if they change the parameters in the regression, starting point, ending point, different indices, weekly, monthly, that the beta was very different. And it troubled them. My suggestion to you is don't be surprised. That's exactly what you should see happen in a regression, because you're drawing a beta from a distribution. And that's part of the reason I don't want to go down that route, because I can sit there in front of a Bloomberg terminal wasting my time trying to figure out which of these betas is the best one, when in fact they're all crappy. So it's a 3-step process for getting a beta for your company. First step, I'd like to get a beta for the business or businesses your company is in. You're saying, how the heck are we going to do that? We'll come to it. That's going to be the first stop. So if you tell me you're in 5 businesses, I'd like to get a beta for the businesses, take a weighted average, and say that's a beta for the businesses you're in. Second, I'd like to adjust for the fact, we talked about how fixed costs increase beta. If your company has much higher or much lower fixed costs than the typical company in the business, I'd like to adjust for it. So if you're a steel company, which has much lower fixed costs than everybody else, you have a very innovative process for making steel, then I'd like to reward you with a lower beta. If you're Southwest Airlines and you have much lower fixed costs than a typical airline, I'd like to give you a lower beta than the typical airline. So I'd like to start with the business beta, adjust for fixed costs if I can, and I'm going to show you why it's so difficult to adjust for fixed costs. And then as a final layer, I'm going to have to adjust for how much you borrowed. The reason being, debt is a choice. You can choose not to borrow money. You can choose to borrow a lot of money. I'm not going to stop you. But at this stage, if you've borrowed money, you've added a fixed cost you did not have until you borrowed the money, I'm going to adjust the beta that I got from the first 2 steps for the amount of debt you have. So get the beta for the business, adjust for fixed costs if you can, adjust for leverage. Now let's take that adjusting for fixed costs and adjusting for leverage adjustments. Okay? It turns out that adjusting for fixed costs is not difficult to do. If you gave me the unlevered beta for the business you're in, the steel business, the retail business, the airline business, the risk of being in that business, and again, you'll have to leave that up to me, is to come up with that number. And you also tell me what your fixed costs and variable costs are, not just for your company, but for every company in the sector. Here's how I'd adjust your beta for the fact that you have a lot of fixed costs or very little. I'm going to take the pure business beta that I get for whatever business you're in. And if you have a lot of fixed costs, I'm going to capture that in the fixed cost to variable cost ratio. It looks like a debt to equity ratio, but it's really about fixed and variable costs. So if you're Southwest Airlines, that number is going to be much, much lower than the number for the rest of the airlines. I'm going to give you an unlevered beta as a company that's lower than the beta for the other airlines. Sounds simple enough to do, right? But to use this, what do I need? I need a breakdown of costs into fixed and variable for every company in my sector. When you get a chance, take your annual report that you have for your company, go into the income statement, see if you can find a fixed cost line item and a variable cost line item. What you'll have is all kinds of crap, right? SG&A. You can try to make assumptions. Maybe SG&A is fixed, maybe it's variable. The problem we have with controlling for operating leverage is not because we don't know how to do it. It's because we don't have good measures of fixed and variable costs. Because you need it not just for your company, but for every company on your list. I almost never adjust for operating leverage, and I'm not shy about admitting why. I say, look, I know that operating leverage matters. I know that betas are affected by operating leverage, but unless I have a really good reason for focusing on it for your company, I'm not going to try to waste my time trying to break costs down. The exceptions are, you asked me to value Southwest Airlines, I do have to confront this issue front and center. Because there you can see the company really is built on a premise of lower fixed costs. But most of the time, I'm just going to take the sector average unlevered beta and say that's the unlevered beta for your company, implicitly assuming that your fixed cost structure can't be that different from the sector. So that's the first step. With financial leverage, though, the adjustment becomes easier. Why? Because unlike costs which are, unlike fixed and variable costs which are not observable, debt and equity should be observable, especially because they're market value numbers. The equity, if you're a publicly traded company, obviously is out there. It's a publicly traded stock price times the number of shares. The debt, as we talked about, you can estimate a market value of debt, or if you're lazy, use the book value of debt. You can come up with the debt to equity ratio. Adjusting for financial leverage is not optional. You have to do it if you can estimate the dollar debt. And there are two ways you can adjust for financial leverage. The first is the approach we talked about in our corporate finance class, where we took the unlevered beta that we got from the previous step by looking at other companies in the sector, and you multiply by 1 plus 1 minus the tax rate. If you're wondering what all those question marks are, for some reason, Office, PowerPoint on the PC doesn't seem to recognize the symbol from PowerPoint on the Mac. Write to Microsoft about it. I'm too tired to even fix these things. So basically, that's what, so at least in your notes, it should still be betas, I think, not question marks. So basically, I take the unlevered beta for the business, multiply by 1 plus 1 minus the tax rate times the debt to equity ratio. Somebody explain to me why the 1 minus tax rate is in there. Debt is a fixed cost, right? It creates interest expenses as a fixed cost. But what's the benefit you get with interest expenses? The tax deductible. So basically, the first approach, that's called the Hamada beta, is based on the premise that interest expenses are tax deductible. So even though debt creates a fixed cost, you get this partial protection because of the tax benefit. There's another version of this equation that some of you might have seen. That equation actually assumes that the beta of debt is 0. It doesn't mean debt is riskless. It just means debt has no market risk. There's default risk but no market risk. And what that effectively means is as I go to higher and higher debt ratios, I take the risk of the business and load it all on the equity investors. So the first approach, you're effectively assuming that all the risk in the firm is borne by the equity investors. That sounds pretty reasonable, right? Until you get to double B, single B, triple C ratings. When you get to be a junk bond, guess what? You own junk bonds in a company. It's like owning equity in the company. In what sense? Everything good and bad that happens in the company is going to show up in your value because you really are part equity investor now. You're bearing some of the equity risk. Do you see where I'm going with this? The traditional equation, the equation we've used almost automatically all the way through the corporate finance class, is based on the premise that the beta of debt is 0. You are going to run into this nitpicker. I guarantee there's one out there who will latch on to this and say, you know what? You're wrong. The beta of debt is not 0. And here's what you should tell him. You're right. Can you please tell me what it is? It'll shut him up really fast. Because if you can give me a beta for debt, I can actually adjust my levered beta for the equity for the beta of debt. The second adjustment actually takes the beta of debt and says, look, some of the risk in equity is borne by the lenders. I'm going to take that risk out of the total, and it's only the remaining risk that goes to equity investors. Again, it's something I never do, valuation, because here's what I'm doing. I'm overestimating the cost of equity at really high debt ratios, right? You're an 80% debt, 90% debt. My approach, my simplistic approach, overestimates the cost of equity. If anything, I'm overestimating the cost of capital. And I am not that worried about overestimating the cost of capital at a 90% debt ratio. I should be cautious of that debt ratio. But if you really want to finesse it, you can actually estimate a beta of debt and adjust your beta for equity for whatever the beta of debt is. How do you get a beta for debt? How do we get a beta for equity? We ran a regression of returns on the stock against returns on a market index, right? Actually, in my valuation book, I have betas for debt based on your rating. So I take triple C rated bonds, double. So basically, I run the same regression using entire classes of bonds, because individual bonds, often you don't have enough liquidity to do this. But the beta for triple C rated bonds is about 0.5 or 0.6, which means by the time you get to be a triple C rated bond, there's a big chunk of equity risk in you. So if you want, you can take your rating for your company, whatever that rating is, come up with a beta of debt based on the rating, plug it into the formula, but do it only if you're being forced to do it. It really doesn't make that much of a difference in your valuations. But at least be familiar with both variations of the equation. Any questions on operating and financial leverage? So we're now ready. Let's set up the bottom-up beta approach. Yeah.
When you give out the beta of the debt,
Yeah.
it's already moving into a distress situation. Can you
When you're, the question was about the beta of debt. I'm not sure. When you're moving into a distress.
does it imply the company is already moving to distress so the equity might?
No, not necessarily. It means that you're bearing. It can start showing up even at triple B, double B, because what happens is when the company does well, you feel a little more comfortable about the debt, right? That's true for every ratings class. It's a triple A, you don't care, because your interest coverage ratio is 15. As your interest coverage ratio starts to go down to 10, to 5, to 4, to 3, you're watching the top line, because a higher top line is better for you. So it's not a discrete point. It's not investment grade and then you get scared. It's just more of a continuum. It starts at 0 at AAA, probably starts to drift to 0.05 at triple B, and then 0.1 at... So think of it as a continuum. The more your debt is, the higher interest expenses are for a given level of operating income, the more you worry about, now, how well is the company doing? So let's set up the process for estimating a bottom-up beta. We went through this process in corporate finance, but it doesn't hurt to repeat the entire process. You're a company. You want me to estimate a beta for your company. Here's the process we're going to go through. First question I'm going to ask you is, tell me what business or businesses you're in. It's a pretty straightforward question, right? So you tell me you're in 2 businesses, steel and hotels. Strange company, but it's your company. Let's say I'll be back tomorrow. I go back to my office and I find as many publicly traded steel companies as I can and as many publicly traded hotel companies as I can. You're saying, why publicly traded? Let's say I find 100 steel companies and 100 hotel companies, all publicly traded. What can I look up for each of them? I can look up a regression beta for each of them. Hang in there. You're saying regression betas are bad. You already told us. Hang in there, because here's what I'm going to do. I'm going to pull up 100 regression betas for the steel companies, 100 regression betas for the hotel companies. I'm going to take an average. Don't play games. Simple average. No weighted averages. Don't, in fact, don't go there. Just take a simple average. You have an average regression beta for being in the steel business, an average regression beta for being in the hotel business. If you can break down costs into fixed and variable costs, we'll come to that. Okay? But the first step is you're going to take these average regression betas, which are levered betas, because they come from a regression using stock prices, and you're going to take out the effect of debt. What does that mean? Remember that equation I showed you for levered beta being unlevered beta times 1 plus 1. So if I gave you the levered beta, which is the regression beta, and I gave you the debt to equity ratio for steel companies, the debt to equity ratio for hotel companies, you can take out the effect of that debt to equity. It's basic algebra, and tell me what the unlevered beta for steel companies and hotel companies is. If you now have the fixed cost and variable cost mix for each of these companies, I can take that unlevered beta and break it down further into how much is a business beta and how much comes from leverage. As I said, though, that's tough to do. So let's assume I can't do that. I have the unlevered beta for steel and hotels. I come back to you. Remember, you were the one who sent me off on this mission. I come back and say, you told me you were in 2 businesses, steel and hotels. Can you tell me how much value you get from each business? Your first reaction is, I can't tell you how much value I get, because remember, these are parts of one company, but I can tell you I get 70% of my revenues from steel, 30% from hotels. I'm almost done. What am I going to do next? I'm going to take a weighted average, 0.7 times the steel company unlevered beta plus 0.3 times the hotel company unlevered beta. I have an unlevered beta for your company. Last step, ask you what debt and equity do you have, not what the sector has, because in a sense this is about you, and you say I have no debt, fine, I put in an unlevered beta as your levered beta. You tell me I have a 20% debt ratio, I plug that in, I come up with a levered beta for your company. Now why am I doing all of this? Because I don't like regression betas, right? How did I get the 100 steel company betas? From regression. So all I've done is replace one regression beta with an average of 100. Law of large numbers, right? I still remember in my statistics class, my statistics professor saying you can take 100 crappy numbers, put them in a pot, stir them up, pull the average up, and the average is magically precise. I'll confess, I didn't quite get it. I think I get it now, and maybe I can pass on this intuition. How can the average of 100 crappy regression betas be precise?
The errors are not correlated, though.
the key word is the errors are not correlated. Some of these betas are going to be overestimated. That's the noise we're talking about, right? Some are going to be underestimated. By averaging, what do? I average out my mistakes. I mean, we do this in life all the time, or should. 3 days into a baseball season, a guy's hitting 500. I ask you, what will we be hitting at the end of the season? He's definitely not hitting 500. In fact, what's the best predictor of what he's going to hit at the end of the season? He's a lifetime 250 hitter. At the end of the season, he's going to be hitting 251 maybe. That first 3 days made a difference. It's amazing how often the law of large numbers bails us out because small samples yield strange. My son is a defensive back on a soccer team. After the first game this season, he was really delirious with joy because he got 2 assists. So it's really difficult in soccer to be the defensive back and being so he came in and he extrapolated across 14 games. I'll have 28 assists. I will lead the league in assists. And I said, Kiran, this is not going to happen. It's not going to happen. You're not an offensive player. So take this joyful moment where you are on top of the rankings. Nurture it. Look at it multiple times because it too shall pass. 6 games into the season, he still has 2 assists. Okay? That's the law of large numbers talking because after individual experiences, you can overestimate what can happen. Yes?
So what you're saying is that there's no systematic bias that is there anyway?
The question is, if there is a systematic bias within a sector, we have to talk about where it's coming from.
Because I have no comparable firm. Because I'm evaluating Aston Martin.
No, all I'm saying is there's no firm-specific component to a beta. That what you do as a company, you can have great management, awful management. Good things can happen to you, bad things can happen to you. None of that stuff should affect the beta because what does beta measure? Your exposure to macroeconomic risk. So when I get a really low beta for a company because I had a lawsuit against me for the last 2 years, Volkswagen's beta is going to drop over the next year. I don't want to use a lower beta to value the company because that is a firm-specific component that's pushing my beta down for this period. And I want to take it out. So anything firm-specific in my beta needs to come out. So when you talk about systematic bias, I'll tell you when this process can get you. Let's suppose an entire sector, banks for instance, post-2008, all became much more volatile. Why? Because you had all this bank risk floating around. If I took the regression betas for 100 banks from 2008 to 2010, I ended up with about 1.32 as my beta. And if I use that as my beta to value all banks in 2010, I was probably basically I was probably overvaluing every bank or finding every bank to be overvalued because the beta I was using was that's the fact where all the betas are getting pushed up because an entire sector's macroeconomic risk exposure is being thrown off by something happening. If that is the case, you know what you need to do? You need to go back to 2006, and that's basically what I did. So the law of large numbers is both across sectors and across time, and that's why I keep these averages for the last 20 years so I can look at them to see if in a particular year a sector is doing something unusual. So laws of large numbers, you can both average across companies and look across time. What you're trying to do is get rid of something unusual that might cause your beta to be too high or too low in a particular period. So draw on the data. There's lots of data, lots of companies. And remember, beta is a very specific number. It's exposure to macroeconomic risk. Don't worry about good. See, we often feel this urge. Right? For instance, yesterday, if you looked at the Volkswagen valuation and ask you, how risky is this company right now after the scandal? What's your first answer going to be? Much riskier, right? But that's not the kind of risk that's going to show up in your beta because that risk is really risk that is specific to Volkswagen. You could still punish the company. How am I going to punish the company? I'm going to lower its earnings. I'm going to lower its cash flows. I essentially have the numerator to work with, not the denominator. And that's tough to get over because we've been taught discount rates reflect risk. Discount rates reflect risk, and we want to bring all risk in. And with publicly traded companies that are going to be parts of portfolios, it's only a piece of that risk that shows up. And that's why we use this kind of pruning approach to get to a beta. So the first and biggest advantage for bottom-up betas is they're going to be more precise. How much more precise? If I have 100 steel companies, and each regression beta is a standard error of 0.25, pretty messy, each beta is pretty noisy, the standard error of my average is going to be 0.025 if they're uncorrelated. You see why it's going to be 0.025? It's going to be 0.25 divided by the square root of 100, which is 1/10 as noisy as any. That's a huge savings. And it should also answer your question, how big a sample? Because I know this question is going to come from some of you later in this class. I'll answer it right now. How big a sample do I need to be okay? And here's my answer. 4 is better than 1. Why? Because a sample of 4, your standard error is half what it was with 1. 9 is better than 4. With 9, your standard error is 1/3 what it was with 1. 25 is better than 9. You see where I'm going, right? The marginal benefits as you go from 4 to 9 to 25 to 100 drop off. So if you get to 9, I'm already okay. Your standard error is 1/3. If you can get to 25, I'm delirious. If you get 100, I'm dancing in the streets. I don't need 400 or 800 or 900 because the savings start to drop off. So that's the first saving. The second, let's say you entered the hotel business yesterday as a company. There is zero chance that a regression beta will reflect that, right? Why? Because I'm going back 5 years and I'm trying to run a regression. But when I do a bottom-up beta, I pick the businesses, I pick the weights. The fact that you entered yesterday doesn't really matter. I throw it into the weights. In fact, I can be proactive. You tell me you're going to be in the technology business a year from now, you know what I'm going to do? I'm going to estimate a bottom-up beta a year from now that includes the technology business. I regain control over the process. And third, if I gave you Ferrari to value, it's an IPO. The fact that it doesn't have past prices doesn't matter because you can estimate a beta for Ferrari based on what? That it's a luxury automobile company. It opens up the possibility that you can now value companies which don't have past prices. Yep.
But what would be my sample? What would my sample consist of? Would that be any firm that does well when Ferrari does well? Like
You could. So you could, I would say start small. Don't get too ambitious. So if I could get Audi and Daimler, I could get enough of those to get to a sample of 7 or 8 firms, maybe I'll stop there. But remember, they don't have to be auto firms. There are firms that supply these luxury automakers that are small companies that are publicly traded. So remember to look up and down the food chain as well. There are companies that feed off the luxury business. There are auto dealerships which are publicly traded that do just luxury automobiles in the US. So I'm going to start with luxury automobiles because I don't want to get too distracted here and go off and bring in luxury, Bulgari and Gucci into my mix unless I have to. So I'm going to start with luxury automobiles. I'm probably going to go global because Ferrari is a global automobile manufacturer. I don't have to stay focused on Italy. And if I don't get enough automobile makers, I'm going to go across and look at other companies that feed into the. And if that doesn't work, then I have 2 choices. I can go to non-luxury automobile makers and bring them in, or go to other luxury manufacturers and others, and you have to make the judgment as to which one will create less bias. And you know what? I might be more inclined to include other luxury good manufacturers in rather than bring in a Volkswagen and a Toyota into the mix because those might be very different businesses. Okay? But it's a judgment call. I can't tell you one is always going to work better than the other. And the one thing I can tell you is it's probably not going to make the hugest difference in your valuation as to which way you go. So make a choice, move on. The worst thing you can do is keep going back and forth. Just choose something and move on. You can always come back and say what if, but that's the key. Yes?
So when you're actually looking at the value of relative shows, you look at correlation of prices.
I would look at correlation of revenues. Right? Because don't look at correlation of prices because that's going to bring in illiquid markets versus liquid markets. I'd look at something very fundamental. Saying, why not earnings? Why not earnings? Because those damn accountants measure earnings and I don't trust them. The less damage you can do to a number, the more I trust it. So I'm going to stay with revenues and I'm going to look at correlation across companies. So as an example, if you ask me to estimate a bottom-up beta for Vale, which we did in corporate finance, so if this table looks familiar, it should. I broke Vale down into 4 businesses: metals and mining, iron ore, fertilizers, and logistics. For my sample, I looked at other companies in each of these businesses, and I was global in every one of them for the simple reason that Vale is a global company. You see why I didn't stay Brazil focused. It would be kind of meaningless to take a mining company and focus it on the country or incorporated. So if I did Rio Tinto or BHP, I'm going to do the same thing, global samples. And you can see the sample sizes. Here, I can't complain about the sample sizes being small. I have really big samples. Okay. And the unlevered betas for each. I got the revenues for each because Vale does provide it. And now I'm going to take a little detour. If I were in a hurry, I would use revenue weights because it's there. The problem, though, is when I do that, I'm assuming $1 in revenue in the logistics business is the same as $1 in revenue. It's the same value as $1 in revenue in the iron ore business. And that probably is a dangerous assumption. So here's what I decided to do. I looked up for each of these businesses, the companies I got in, I computed a multiple of enterprise value. You know what enterprise value is? Market value of equity plus debt minus cash. It's an estimate of the value, the operating assets of each company. The market is attaching to each company divided by the revenue. So what would that tell me? If I trust that number, 1.97, a typical metals and mining company, $1 in revenue is valued at $1.97. You see what I'm trying to do? I'm trying to convert the revenues into estimated values, and I'm going to use revenues times that multiple to come up with my estimated value. Last column, I add up the estimated values and take the weight of each one. And at least based on my judgment, it looks like Vale is about 76% iron ore, about 17% metals and mining, about 5% fertilizers, and about 2% logistics. Those are the betas that feed into my levered beta equation. Here I did make the assumption that all of these businesses have roughly the same debt ratio. They're all big infrastructure, capital intensive businesses. I use the same debt ratio. But if I want to finesse that and assume that some businesses have more debt than others, then I need a basis for allocating debt across the divisions. I come up with a levered beta, and that levered beta is what I'm going to use to come up with the cost of equity for each business. Incidentally, in the case of Vale, I did everything in US dollar terms. Why? Because it's a commodity company. It's easier to do the valuation in US dollars. So the risk-free rate is the US dollar risk-free rate. The equity risk premium reflects where Vale gets its revenues. More China than Brazil in there. So there's my cost of equity by business. Not only can I give you a cost of equity for Vale as a company, but this is a real-life scenario where Vale is actually trying to sell the logistics business right now. So let's say you're the banker, you're called in to value the logistics business for sale. Which cost of equity are you going to use in valuing the logistics business? You should be using the 10.29% cost of equity, not the cost of equity for the company or the cost of equity for the other divisions. And that's the advantage, again, of doing bottom-up betas, is you can tell me what to do when I have to value a piece of the business. So that's a pretty straightforward example. You break the companies down, and usually the annual report, the 10K, will give you a breakdown by business. Sometimes you've got to be a little creative in how you define businesses. But think about what we talked about. You want to find other companies that do well when you do well and do badly when you do badly. That should be the core of how you think about comparable firms. Now here's another Brazilian company, Embraer. Aerospace company. I want a beta for an aerospace company. I told you I always start narrow. So I started by looking for other Brazilian aerospace companies. And I got a sample of one. It was Embraer. That doesn't work for me. Embraer replaces Embraer. I said, let me look at all Latin American aerospace companies. I got a sample of one. Embraer. Let me look for emerging market aerospace companies. I got a sample of 3. Then I said, why am I even playing this game? Over the weekend, I flew to Williamsburg to visit my daughter at Parents' Day. And it was one of those little propeller planes. Actually, going there was an Embraer, coming back was a Bombardier. And I'll wager that if you take short haul flights, that you've been on a lot of Embraer flights. What I'm trying to say is Embraer is a Brazilian aerospace company, but it's really selling aircraft all over the world. It's a global aerospace company. So if I'm doing Bombardier, Embraer, Boeing, EADS, they're all in the same business. So I basically looked up the unlevered beta for aerospace companies, not just in Brazil, but across the globe. That unlevered beta was 0.95. I used Embraer's debt to equity ratio to come up with a levered beta 1.07. Now when you do this, or if you do this, I will wager that there's going to be somebody in your group who's going to say, but you can't average betas across different markets. I am, right? I'm using a beta for Boeing, which is a US company, with a beta for Bombardier, which is a Canadian company, the beta for EADS, which is a European company, and a beta for Embraer, which I'm putting them all into the same sample. You can't do that. What's the average beta across all European companies? Don't think too long. 1. What's the average beta across all Brazilian companies? 1. What's the average beta across all Indian companies? 1. You see what the advantage of betas is? It's scaled around 1. One of the nice things about betas is I can average betas across markets. I can't average PE ratios across markets because PE ratios might be different in different markets. The average PE ratio in Brazil right now is much lower than the average PE ratio in the US. But betas I can. Desperation will often lead you down the global route. What I mean by that is, you go to work for an emerging market and you stay focused with that emerging market. You're a Greek analyst, God help you. How the heck are you going to find enough companies in each sector to get a comparable firm sample going? You have to go at least European and probably global to get enough companies in your sample. I will tell you the one assumption you're making when you do this. You're assuming, remember we talked about discretionary, non-discretionary last week as a driver of betas, the last session? When you average betas across companies, you're assuming the product or service you're looking at is about at the same point in the discretionary, non-discretionary scale across markets. Not a big deal with aerospace. Because it's not like you and I sit around and say, can we buy a plane tomorrow? I'll tell you when it's going to make a difference. If you're estimating the beta for a product or service which is non-discretionary in some markets and discretionary in another. Say telecom services. Pretty much non-discretionary in much of the developed world, right? Let's face it. You will give up groceries before you give up your cell phone service. At least my daughter will. It's become pretty much. So betas for non-discretionary products and services are lower. But you look across many emerging markets, that same service could become a much more discretionary service where people say, if I can afford it, I will get X, Y, or Z. That same product becomes more discretionary, which means that if I'm estimating the beta for telecom services, maybe I want to have 2 samples, one for developed markets and one for emerging markets. And if I'm estimating the beta for an emerging market telecom company, I'll go with the average across emerging markets. So that's why on my website I report 5 averages for every sector. It looks like overkill, but I want to give you the options. I report an average for the US, if you want to stay US focused. And one of the advantages of US focus is the beta is estimated against the S&P 500. The betas tend to be a little more reliable because the index is much bigger. I give you European companies collectively, not any individual country, because each country is too small to create a large sample. I have, by Europe I mean just developed Europe. So, and by developed Europe I've got to be careful. I include a lot of Southern Europe, which is actually very quickly slipping off into the, I wouldn't say undeveloped Europe, but into the dark side of Europe. But for the moment I'm still leaving it with the EU, the UK, Switzerland, Northern Europe. Maybe I have to start breaking out Southern Europe and treating it as part, because Eastern Europe right now is going into my emerging markets. It's kind of arbitrary because it reflects the way we've thought about these markets, but why should Poland be viewed as part of the emerging markets and Greece be viewed as part? So there are all these lines that are being drawn that are but I use the conventional practice of emerging markets. I also then report a global average and an emerging market average. So you can pick and choose what you want to use for your beta depending on the product or service you're looking at. Okay? Sorry. One thing about Embraer, and this is something that those of you who worked outside the US in financial services might have run into. I used a gross debt to equity ratio when I levered Embraer's beta. You know what a gross debt to equity is? I take the total debt and I divide by market equity. I actually prefer to work that way, but if you worked outside the US, you often use net debt to equity ratios. What's net debt to equity? You take total debt and you subtract out cash. You're saying, how big of a difference will that make? Think about what it will do for Apple. Apple is 50 billion in debt. How much in cash? 200 billion in cash. And already you're freaking out. Oh my God, my debt to equity ratio went negative. Let it go. It's okay. Because with the net debt to equity, you can get a negative number, and you have to live with that negative number. And let me show you with Embraer what the numbers would have looked like. The gross debt to equity ratio was 18.95. The levered beta using that was 1.07. The net debt to equity ratio for Embraer at the time that I did this was minus 3.32%. Why? Because the cash balance exceeded their debt. Hang in there. If I use a negative net debt to equity ratio, my unlevered beta, my levered beta is actually lower than my unlevered beta. It's okay. You say, but I'm getting two different betas. It's okay. Use the lower beta, you're going to end up with a lower cost of equity, right? You're saying, I told you so. I should have used the 1.07. It's still okay, because here's what's going to happen next. The cost of equity goes into a cost of capital calculation, right? When I use my gross debt to equity, here's what I used. I used the 1.07 beta to come up with the cost of equity that I then weighted using gross debt to capital and so basically it would have been about 14% debt, 86% equity. I'd have ended up with the cost of capital. If I use net debt to equity, I end up with a lower beta and a lower cost of equity. When I get to my cost of capital, you know what the weights are going to be? They're going to be about 103% equity and minus 3% debt. And this freaks people out. How can it be negative? Because you're bringing cash into the process. Cash is a zero beta asset, and what that effectively means is your cost of capital will actually be higher than your cost of equity. And if you do this right, try this out for a company, your costs of capital are going to be pretty similar using both approaches at the end, as long as you stayed consistent about using net debt ratios all the way through. What I mean by consistent, a lot of analysts, if the net debt ratio goes below 0, will arbitrarily floor it at 0. Why? Because they've been told debt ratios can't be negative. If you do that, you're going to get very different answers. So if you're going to use net debt ratios, stick with it all the way through in levering and unlevering betas and doing the cost of capital, doing the cost of equity. It's going to be okay. It's not the end of the wood. It's just a slightly different tweak on your cost of capital. Any questions on net debt ratios? So let's bring all the numbers and the cost of equity together. If I asked you to estimate the cost of equity for a company, what do you use as a risk-free rate? It will depend on whatever currency you've chosen to do the valuation in, right? So get a risk-free rate in the currency of your choice, more work in some than others. For the equity risk premium, you have a choice of historical or forward-looking. If you can, use a forward-looking premium. If you have additional country risk, bring that in. Reflect where your company operates, not where it's incorporated when you do the equity risk premium. And your beta will reflect the businesses you're in and how much debt you're using to fund those businesses. Everything has a place in the equation. Don't let the numbers do double work. What I mean by that is often you'll see analysts looking at this equation, trying in every input to bring in the fact that this company is a risky company or an emerging market company. And if you do that, you'll end up double counting or triple counting risk, because here's what you're going to do. You'll get to the risk-free rate and say, it's a Brazilian company, I'm going to use a higher risk-free rate. Maybe the Brazilian dollar bond rate rather than the US bond rate. So your risk-free rate is already higher. Then they'll get to the equity risk premium. They'll use the same rationale. It's a Brazilian company, so I'm going to use a higher risk premium. They even get to the beta and say, you know what, it's a Brazilian company, so I'm going to take the US betas and move them up arbitrarily to reflect the fact that you've triple counted risk if you do that. So let everything do its job and it's going to work out. But if you let kind of things get mixed together, it's very easy to get confused. Any questions at all about cost of equity? Let's now talk about the cost of debt. Let me repeat what I said. It's a rate at which you can borrow money long term today. So let's start with the easiest companies to estimate the cost of debt for. So if I wanted to observe the interest rate today, one of the easiest places to go is if you have bonds outstanding as a company, and those bonds are traded, what am I going to be able to observe on those bonds? I'm going to observe the yield to maturity, the interest rate on the bond today. So why am I even looking for that? It's right there in front of me. I have a 10-year corporate bond in AT&T. The rate is 2.95%. There's my cost of debt. I'll also tell you that I almost never use this approach to get a cost of debt, and here's why. Can a risky company issue a safe bond? Absolutely, right? Because all you need to do is take your safest assets, and issue a bond that is secured by those safest assets. One of the problems with focusing on an individual bond, and that's why ratings agencies actually have two ratings. They have a rating for the company and they have a rating for a bond. The two don't have to be the same. So you can actually have a company with a single A rating and a bond issued by the company with a double A plus rating. So the first reason I'd be careful about using an interest rate in a bond is, who knows what that captures. But the nice thing if you have bonds outstanding is, what else do you usually have? If you have corporate bonds outstanding, what else can I find for your company? I can usually get a rating for the company. It's not required. You don't have to be rated to issue bonds. You can choose to issue bonds and refuse to get rated, but you know what people read into their decision? You chose not to get rated, so you must be risky. So most companies that have bonds outstanding have a bond rating. And here we're entering into some dangerous ground. But if we assume that ratings agencies know what they're doing, that's a dangerous ground, then the rating becomes your proxy for default risk. And if I know the rating for your company is triple B or single A, I can estimate the default spread based on that rating, right? It's public. I mean, I can go find other bonds traded. So those are the easy scenarios where you have a rating or an interest rate. I can use that and run with it. But if you cannot find a rating, don't go back to a book interest rate. There is a better option. So let's talk about what to do when you cannot find a rating. I'm going to describe a process that from my corporate finance class you should be familiar with, which is called the synthetic ratings process. What's synthetic about it? I'm acting like a ratings agent. This isn't coming from Moody's or S&P. This is coming from me. So what I'm going to do is I'm going to look at what they look at, which is your financials. I'm going to look at the ratios they look at, which I know because they list out the 8 or 9 ratios they look at. And I'm going to say, based on your numbers, your rating should be single A, double A, triple A. Sounds complicated, but I'm going to keep it as simple as possible. In fact, I'm going to take all the different ratings I can get on your ratios that I can get in your company, focus on one. It's called the interest coverage ratio. If you remember your accounting class, interest coverage is basically operating income divided by interest expense. The higher that ratio, the more buffer you have as a borrower. So the higher the ratio, the safer you are as a company. So I can compute that ratio for pretty much any company. Here, for instance, I took Embraer. I took the average operating income across 3 years and divided by the interest expense. The interest coverage ratio I come up with for Embraer is 3.56. Now by itself, you're saying, I don't know whether that's good, bad. I want to convert that coverage ratio into a rating, right? So starting about 20 years ago, I started creating a table, a lookup table, by looking at all rated companies, looking at their ratings and interest coverage ratios and saying, if I know what your interest coverage ratio is, can I convert that coverage ratio into a rating? So this is based on looking at actual rated companies. And here's what the table looked like. In 2003, with an interest coverage ratio of 3.56, okay? So there are two sets of numbers here, one for large developed market companies and the other for emerging market or risky companies. I'm going to go with the second column. 3.56 puts me right there. The rating I would give Embraer based on that coverage ratio would be double B plus. If I treated them as a large company, the rating I would give them is A minus. They actually had the market cap to qualify as a large company. So what I'm doing is I'm looking up the interest coverage ratio on that table and looking across for what your rating is. And those were the default spreads. And you can see in 2003 and 2004 they were different numbers. So depending on when I'm doing the valuation, I'm going to look up the default spread based on the rating. So 3-step process. Compute the interest coverage ratio, go to the table, look up the rating, use the rating, come up with the default spread. You're done. For Embraer, actually, the number that I actually used the safer company thing, because in 2003 I made, because it got 97% of its revenues outside Brazil. The rating I attached to them was A minus. The 2004 default spread was 1%. And the risk-free rate then was 4.29%. So basically what I did was I took the 4.29% T-bond rate as my risk-free rate, because I'm doing everything in US dollars, added the 1% for Embraer. And normally that's where you'd stop, right? You add the default spread. But here's a problem I'm going to face. Embraer is a Brazilian company. You think, so what? When Embraer goes to borrow money from a bank, the bank is going to say, show me your financials, and they're going to look at how risky you are. Then they're going to ask, where are you incorporated again? You say Brazil. They're going to add an extra 4% to your interest rate. You think, that's not fair. Life isn't fair. If you're a Greek shipping company, you walk into a bank and say, I'd like to borrow money, the bank says 20%. But you haven't looked at my financials yet. You're Greek. Argentine company, Venezuelan company. It's not fair. It's the reality, though, that when you borrow money, your country attachment comes with you. In fact, the ratings agencies used to be explicit about this. They used to have what were called sovereign rating ceilings. Have you heard of these? Until 2002 or 2003, no company in a country was allowed to have a rating higher than the country. So if you're a Brazilian company, and that rule was still in place now, your rating could not exceed Baa3, because that's a rating for the country. Eventually, the ratings agencies abandoned that rule because it turned out that some companies were able to borrow money in the market lower than the country. So that rule is now only loosely enforced, but it's still there, which is when a ratings agency looks at you as a company, your country of incorporation plays a role in what kind of rating you attach to. Which means when I do my cost of debt with a synthetic ratings process, I've got to add a country default spread on top of a company default spread. Is everybody clear on the intuition I'm using? So I start with the UST bond rate as a risk-free rate. I add the default spread for Embraer, which is 1%. And then I could have added the entire Brazilian default spread then, which was 6.29%. But given the fact that Embraer gets so much of its revenues outside Brazil, I added only a portion. You're saying what portion? You can even use the lambda that we used earlier when we did equity risk premiums to scale down the default spread. My cost of debt for Embraer on a dollar basis, pre-tax, is 9.29%. So when you do cost of debt for emerging market companies, especially if you don't have a rating, it's a three-step process. Start with the risk-free rate, add the default spread for the company, then add the default spread for the country. Because all three numbers will push up your cost of debt. Okay. Any questions? Few caveats about that table. That table was developed looking at almost entirely US companies. Part of the reason for that is not because I was US centric, but at the time that I started doing the table, most rated companies were US companies. So increasingly, as more foreign companies are being rated by S&P and Moody's, the table's getting richer. But it still doesn't have a lot of emerging market companies in it. Saying, so what? What am I doing? I'm taking the interest coverage ratio. I'm getting a rating based on the interest coverage ratio, and I'm getting a default spread based on the rating, right? That default spread, though, is a dollar default spread. The 1% is a dollar default spread. So when I used the T-bond rate as my risk-free rate, it was okay. I could add the default spread. But what if I were doing everything in nominal reais? Remember what the risk-free rate was in nominal reais? It was like 11%. Do you see where I'm going with this? If the default spread you're charging is 1% on a dollar risk-free rate, which is 2 or 3 or 4%, do you think the default spread might be higher if you're building off a base of, let's say, 11%? The higher your risk-free rate gets in the local currency, the more dangerous that table becomes as a way of estimating ratings and interest coverage ratios. I can give you kind of fixes you can make to the table, but keep that in mind. That's a warning that goes with the table. Is if you're in Nigeria or you're in Brazil or you're in Russia and you're trying to estimate a cost of debt in the local currency for your company, this approach might actually create some problems because you're understating the cost of debt for your company by adding a dollar default spread to a much higher risk-free rate. So that's the only thing that I would bring out, and the default spreads, obviously, you need to keep updating. Why? Because the numbers change. Remember 2008 where the equity risk premium started the year at 4%, ended at 6.5% the year of the crisis? I took that same year so you could see how much default spreads can change. So let's pick a rating. Let's pick investment grade. Investment grade is BBB. At the start of the year, the default spread in a BBB rated bond was about 2%. That is 2008. At the end of the year, your rating hadn't changed, but look at what the default spread had gone to. It had gone from 2% to 5.75%. So your rating stayed the same, but the price of risk in the bond market pops up. The default spread is going to reflect it. So you can't stay with a table that's 2 years, 3 years, 4 years old. You need to update your default spread. It's not every day. Don't do that. That's too much. But at least once every 3 or 6 months. And you probably remember the site we used in corporate finance to update. It's Bonds Online. It's one word, bondsonline.com. Okay? So you go in, you type in bondsonline.com. The good news is you can get updated default spreads as of this moment. And this is actually a typical bonds online table. So basically it lists the default spreads for every maturity, 1 year all the way to 30. And it lists them by rating class. He's saying this is great. That's the good news. You can get the updated numbers. The bad news is they'll charge you $99. Which means that you probably shouldn't spend the money now because you probably need the $99 for better things. I did update it a few months ago, so you can use my numbers. Essentially, I paid the $99. But I'll subsidize you for the moment. Okay? But when you get out there, you need a source of updating default spreads. Maybe your bank, investment bank, trading house, portfolio management that you work for already has these, but you need to be able to update these default spreads because they do change over time. Any questions? Few loose ends. Sometimes when you look at a company and you look at the debt they have, some of their debt might be subsidized. Why? Because the government really likes you. You're in the national interest. In fact, Embraer, for instance, at one point in time, this is no longer the case, had a loan from the Brazilian government at a rate much lower than the rate they would have borrowed. So basically the government lent, and this is across the world. There are governments that will give out subsidized loans to some businesses, some companies, because they view them as being really important companies. So let's say that's true in this case. Then instead of borrowing at 9.29%, Embraer has these loans that it has taken on with an interest rate of 6%. And it's actually a current rate. The government is actually ready to lend to. So it's not like the old book interest rate problem. The government is actually willing to lend to you at below 9.29%. So my question is a pragmatic one. You're sitting there valuing Embraer. You need a cost of debt for your cost of capital calculation. Half your debt comes from the government at a 6% rate. Can you use that as your pre-tax cost of debt? Can is a weak word. Of course you can. Let's carry through. What will happen if you use that as your pre-tax cost of debt? Your cost of capital is going to be lower, and your value as a firm is going to be higher. Why is it higher? Where's the extra value coming from? It's coming from a government subsidy, right? Nothing wrong with that. It is value that you get as stockholders. But do governments ever do things without expecting something in return? I might be cynical on this one, but if the government gives you a subsidized loan, might they come knocking on the door another day asking you for something in return? Almost always. There's another shoe waiting to drop, right? What's that other shoe? Maybe they would require Embraer to sell aircraft to Brazilian airlines at 10% below the stated price. Why? Governments do crazy things, we don't know. And that'll cost you, right? So you get a benefit from the subsidized loan, you get a cost because you're required to have this price fixed contract. Is that net effect always going to be positive? Not necessarily. In fact, when I often do this calculation for companies, because they want to count the subsidy, I'll say, you know what I'll do? I'll value the company as if you have no subsidy. I'll always start off with the 9.29%. I come up with the value for the company. They say, but you're not counting the subsidy benefit. I said, that's easy to do. The subsidy benefit is actually separable, right? The subsidy benefit is you borrowed at 6 instead of 9.29%. There's a 3.29% saving. I'll take the present value of that benefit and claim it as a subsidy benefit. The advantage of taking it away from your cost of capital calculation is you can now put a finite life on it. Governments don't subsidize you forever. And you can also bring in the other side of the subsidy. What else is the government asking you to do in return for the loan? And let managers decide whether, in fact, this is a good idea or a bad idea. By bringing in the subsidy into your valuation, you lose that chance. So if you have any kind of subsidy, act as if you have no subsidy when you do the valuation, then value the subsidy separately, whether it's a revenue subsidy, a cost subsidy, an interest rate subsidy, value it separately. See what you get as a benefit, but always look at the cost. Okay. So we've got a cost of equity from the risk-free rate, the beta, the risk premium, the cost of debt as a long-term cost of borrowing money now. We need weights for debt and equity. And let me give you some alternatives to the weights. You tell me which one we should use. In fact, let me take that away from you. If you open up any corporate finance valuation book, you're told to use market value weights. Anybody here doing the CFA exams? Right. Every year I have no CFA, I have no desire to get a CFA. You can't drag me into the CFA. It's too many thousands of pages for me to read. Right. But every year I beg them to let me write their exam for them, because I give the keynote every year at their CFA conference, and I said, this year, will you let me write your exam? Because CFA exams are like endurance tests now. Because if you've done the CFA, you know exactly what I'm doing. They'll ask you to read 7,355 pages. It's a closed book exam, and they'll ask you, what was on page 4,321? Get it? Go back. Because the reality is the CFA has become much too popular for its own good. To keep its value up, they have to fail about 65% of the people. And this is the way they failed them. And I said, this is not a way in which you're separating the wheat from the chaff. You're just separating the people who remember, have this encyclopedic memory, from the people who don't. Let me write the exam. And if they let me write the exam, it'll be one question. If you got the answer right, I'd give you all 3 levels of the CFA. Ready? Let's do an unofficial CFA exam. I'm going to ask you the question. If you get the answer, you get a demodorant CFA. You can add it on to your name. Right? So with this fixation of market value, why do we use market value weights in the cost of capital? And I'll give you the choice. In fact, I'll make this a multiple choice exam. So there's actually, you can pick one and by chance be a CFA. Right? You just pick one randomly. Is it because the market is usually right? Is that why we use market value weights? If you pick that, what's the trap you're devising for yourself? Let's say you use that argument. Market's usually right, that's why I'm using market value weights for the cost of capital. Tell me the rest of the story. What are you using this cost of capital to do? You're going to value the company, come up with the value of equity, compare to the stock price, and then what are you going to tell me? The market is wrong. So don't ever bring up the market is usually right, because then later on I'm going to come back and say, well, how come the market is usually right on this particular stock? With you doing the valuation, the market turned out to be wrong. So the answer is not that the market is usually right. Is it because market values are easy to obtain? Yes, but so are book values. It's right there on the balance sheet, right? It's not like one is easier than the other. Is it because book values are meaningless? The accounting hater in me says, of course, that's the reason. But they're not quite, right? There's all these little rules I know that throw off book value, but they're not meaningless. So what's the answer? This is not a very good multiple choice, because if you pick D, I'm going to ask you what's none of the above is fine if you can tell me what then is it. Why do we use market value weights? Because if you answer this, you're kind of getting a sense of what drives DCF valuation. Remind me again what we're doing. We're valuing a company, and if we like the company, what are we going to do? We're going to go buy the company, right? Or buy shares in the company. When you buy shares in the company, what do you have to pay? You have to pay the market price, not your estimated intrinsic value. So if I buy Volkswagen, you know what? I bought Volkswagen yesterday. I paid $96 euros per share. Not the 111 that I estimated, but you see where I'm going with this? We use market values for a very simple reason. DCF valuations, you're acting as if you're buying all the shares in the company and all the debt in the company today. And guess what? If you do that, you got to pay market prices, not your estimated intrinsic value. Not you think. So it's a purely transaction-driven reason. You know when that reason doesn't make sense? Is when I value an IPO or a private business, because then I don't have a market price. We'll come back and talk about what to do with those. But that's how you resolve this inconsistency, that the weights you're using for your cost of capital are actually different than the numbers you're telling me this company is worth at the end of your process. So you all have the CFA Act like you gave the end, so it's good. So after the class, come by with a certificate. I'll sign it, and you can add it onto your name. It becomes an appendage to people's names, right? CFA, ASA, et cetera, et cetera. Last piece of the process. Let's bring the market values in for Embraer. So this page we've been leading up to because we've had Embraer as kind of a lab experiment all the way through. So this is in 2004. You asked me for a cost of cap for Embraer. First, I decided to do everything in US dollars. I'll tell you why in 2004 I had to do it in US dollars. In 2004, there was no Brazilian nominal real denominated long-term bond. That started in 2006. So I didn't even have a choice of doing it in real, so I did everything in US dollars. The risk-free rate is therefore the UST bond rate, 4.29%. To get to the cost of equity, I took the beta. The beta is the aerospace, global aerospace beta, 1.07, multiplied by the mature market premium because 97% of Embraer's revenues came from mature markets, no, 4%. And the 4% was the implied equity risk premium for the US in 2004. And then I took the lambda, and I don't know whether you remember, but the lambda I got by looking at how Embraer moved relative to the Brazilian CDS or Brazilian dollar bond to capture the country risk. And I multiplied the lambda by the country risk premium for Brazil. So I'm bringing in the country risk premium to lambda approach, cost of equity of 10.7%. For the cost of debt, I start with the same 4.29% and added two default spreads. We just went through this, 1% for Embraer's default risk, 4% for Brazil's default risk, came up with a cost of debt of 9.29%. Market value of equity, share price times number of shares, was 11,042 million reais, or $3,781 million. Market value of debt, I took the book value of debt, which was 1,953 million. I took the interest expense, so both of those came right from the financials. I was also able, from the footnotes, to back out when the debt was coming due in about 4 years. You see, how does that help me? Think of it as a 4-year gigantic coupon bond with 222 million as your coupon every year. That's the annuity each year for 4 years. Plus the 1,953 million is your face value at the end of the 4th year, and discount them all back at the 9.29%. What I get as a present value, 2,083 million, is what I use as my market value of debt. I put that in as weights. It turns out to be 84% equity, 16% debt, cost of capital of 9.97% in US dollar terms. If I wanted to convert this into reais, let's say you're doing a valuation, you get all the way to this stage, and the manager on the other side says, you know what, I don't like this dollar stuff. Do it all in nominal reais. Your stomach drops, right? Looks like you got to go get started. There are two ways you can convert this into a nominal reais. One is the long way, and that is to take everything in nominal reais, do a nominal reais risk-free rate, default, so start from scratch again, which will give you much higher cost of equity and cost of capital. I actually am going to suggest the second approach because I think it's not only quicker, it's actually better. What do I have? I have a dollar cost of capital of 9.97%, right? I'd like to convert it into a nominal real cost of capital. Remind me again why currencies matter. Differences in expected inflation, right? If I told you the expected inflation rate in reais is 8% and the expected inflation rate in US dollars is 2%, and you're in a hurry, what are you going to do? You're going to take the difference, 8 minus 2, 6, and add it on to the 9.97%, and you're going to have a nominal real cost of capital. So adding the differential inflation to a dollar cost of capital. If you have the time, do it right. What doing it right requires is to take into account the compounding effect. What that effectively means is instead of getting 15.97%, you get a number slightly higher because the numbers feed on top of each other. So it's an incredibly useful device for converting cost of capital in one currency to another. It eliminates it from the game and essentially lets you work with any currency you want. Final piece. Right? When you look at your company, some of you might discover that you have securities that are not quite debt and not quite equity. Convertible bonds. So where do I put that? Preferred stock. Where do I put that? If you can, if you have these hybrids, you want to break them down into their debt and equity components. So this is the last thing for today. What I'm going to do is I'm going to take a convertible bond that your company has and break it down into debt and equity components. Okay? So here's the company. It has a convertible bond with a $125 million face value and a coupon rate of 4%, a 10-year maturity and a market value of $140 million. So that's a convertible bond out there. My job is to take the $140 million and tell you how much of it is debt and how much is equity. What are the two securities in a convertible bond? There's the straight bond and there's a conversion option, right? Which is the easier one to value? Value the bond. Why go with an option pricing model? So here's all I did. I took the convertible bond and said, if I remove the conversion option and I treated this as a straight bond, what would it be worth? So basically it is a bond pricing. So that's a coupon, that's a face value, discounted back at the current cost of debt based on your rating, gives me 91.45 million. Out of the 140 million, 91 million is debt. The remaining 48 million is equity. I'm going to take the debt and put in with debt, the equity with equity. The convertible bond is now gone. I have only two pieces in my cost of capital. And that's the end of the cost of capital process. You can get the discount rate behind you, because next session when we start, we're going to start with cash flows, earnings, growth, because that's where the real damage is done. So review this stuff because it matters, not as much as you think, but it does matter in driving the valuation of your company.
Videos about how to use financial statements to like get the most relevant information and stuff like that. I was wondering, as a quick tip, if I want to start investing and like doing valuations for that purpose, what videos would you recommend in particular as like high impact? Because those were really helpful just in terms of like basic stuff for approaching financial statements.
I think rather than start with the video, start a valuation and see where you get stuck.
Okay.
Look for a video that lets you get unstuck. Right? Because otherwise you'll be watching 15 videos, 12 of which you might never use.
Right.
So actually start the valuation, get stuck there. How do I get training from them? Look at the video and get that one is you have a product service discretionary it's not about aerospace, but if I give you consumer products, this you can do it non-discretionary. Asia does well, you can get a lot of growth because it becomes a higher beta business in Asia than emerging market data, producing products. Cost of acquiring the equity in the company. You've got to go buy the equity in that, guess what?
Just for the project or work or whatever reason I'm doing an emerging market company, do I start off with like do I think about do I do what you did before with I use the just for default strategy, do bottoms up